It appears statistically improbable, perhaps even theoretically impossible within standard economic frameworks. The United States real estate sector recently recorded its lowest sales volume since 1995. Essentially, fewer properties are changing hands today than at any juncture in the last 3 decades. Yet, in defiance of basic economic principles, home valuations are hovering near unprecedented peaks. We are witnessing a simultaneously occurring phenomenon of reduced buyer activity and escalated pricing. In a conventional market, these forces should counteract one another. This is the fundamental law of supply and demand that forms the basis of introductory economics. And yet, this is our current reality. The market has stabilized into a state of paralysis. Valuations have reached the point of absurdity. The demographic of the average first-time purchaser has shifted dramatically, now averaging 40 years old. For anyone who has attempted to navigate this terrain recently, the intuitive sense that the structure is fundamentally flawed is inescapable, even if the precise cause remains elusive. The objective of this analysis is to perform a service that the real estate industrial complex, the mortgage sector, and the broader financial media are structurally disincentivized to provide. We aim to deconstruct precisely how this market reached this state, examining every contributing factor sequentially and analyzing the hard data. This clarity is essential for any prospective participant wishing to engage with the market while fully informed. It is necessary to process the actual mathematics behind the situation. To begin, consider the current median price of an existing home, which hovers around $418,000. For context, in 2019, that figure was approximately $272,000. This represents a 46% appreciation. Critically, this is not localized appreciation in hypermarkets like Manhattan or Palo Alto. This is the national median, representing the true center of the country. Furthermore, current mortgage interest rates are established in the vicinity of 6.5%. While perhaps superficially manageable, this figure must be compared to January 2021, when a 30-year fixed mortgage could be secured at 2.65%. These are, functionally, two entirely different financial realities. To understand the impact of this divergence in tangible currency, consider a property with a $400,000 acquisition price. With a 20% down payment, the resultant $320,000 mortgage at a 2.65% interest rate would necessitate a monthly principal and interest payment of $1,293. At the current rate of 6.5%, the identical loan amount requires a monthly allocation of $2,023. This is a disparity of $730 every single month, spanning 3 decades, for the exact same physical asset, the same structure, the same surrounding infrastructure, and often an underwhelming parcel of land. Furthermore, this asset itself now costs $146,000 more than it did 6 years prior. Consumers are simultaneously facing higher borrowing costs and higher acquisition prices. This is not a matter of misfortune. It is the direct consequence of a specific sequence of policy decisions and exogenous shocks that have compounded over the past 5 years. When examined in sequence, the current scenario transitions from seeming chaos to appearing as a predictable outcome. The narrative originates in 2020, The global landscape was dominated by an unprecedented health crisis. In an act of emergency financial mitigation, the Federal Reserve reduced interest rates to near-zero levels and initiated the purchase of $120 billion in bonds and mortgage-backed securities on a monthly basis. This flooded the financial ecosystem with liquidity, a commitment analogous to starting a fire and perhaps overestimating the required fuel. By January 2021, the 30-year fixed mortgage rate had descended to 2.65%, the lowest figure recorded by Freddie Mac since 1971. Prospective buyers who had previously delayed market entry suddenly realized they could service a vastly larger loan amount for the same monthly commitment. The resulting demand surge was significant. However, this demographic factor was only one component of the equation. The pandemic fundamentally altered American priorities regarding residential spaces. Domestic environments were abruptly repurposed as offices, gymnasiums, educational facilities, and primary sites of recreation. A constrained urban living space that was previously acceptable now felt insufficient for 24-hour occupancy. The prevalence of remote work surged from under 6% to over 18% in a remarkably short time frame. Millions of individuals began evaluating their living situations with a specific question. If geographic location is untethered from employment, why tolerate high costs of living in less than ideal environments? This catalyzed a significant migration. Dense urban centers like Manhattan, San Francisco, Chicago, and Los Angeles experienced substantial household outflows. This population influx descended upon secondary markets and mid-sized cities, regions already characterized by constrained housing supply. These areas suddenly faced a deluge of buyers armed with substantial pre-approvals, accumulated pandemic savings, and an urgent requirement for functional domestic space. Consequently, national property valuations accelerated by 37% between March 2020 and March 2022. This rapid appreciation did not occur over a decade. It transpired within a mere 2-year window. Specific markets experienced hyperappreciation. Austin saw a 61% increase, Phoenix 59%, and even tertiary markets like Boise, Idaho, experienced a 53% climb. At the height of this activity, nearly 6,000 homes were selling for $100,000 or more above their advertised list price in a single month, transactions involving typical residential properties. For those who acquired property during 2020 or 2021, the timing often resulted in highly favorable financial outcomes, driven primarily by market forces rather than distinct acumen. However, for those positioned outside the market during this brief window, subsequent developments proved catastrophic. By mid-2022, consumer price inflation reached 9.1%, the highest level in 4 decades. The response from the Federal Reserve was traditional central bank policy implemented with historical aggression. 11 rate increases over a 16-month period, raising the target range from 0.25% to 5.50%. This constituted the most rapid tightening cycle in 40 years. Mortgage interest rates adjusted upwards in lockstep. In January 2022, rates were 3.22%. By October 2022, they reached 7.08%, and by October 2023, they touched 7.79%, the highest point since the turn of the millennium. These escalated rates were applied to the same homes that buyers had fiercely contested just 18 months prior. At a 7.79% rate, a $320,000 mortgage commitment increases to $2,302 per month, compared to $1,293 at the pandemic lows. This represents a $1,000 increase in monthly obligations, totaling $363,000 in additional interest payments over the life of the loan for an identical property. To qualify for the acquisition of the median-priced home at today's 6.5% interest rate, a household must generate an income of approximately $106,000 annually. The current median household income stands at $83,700. Thus, the average American family falls $22,000 short of the qualifying income for the average house. Additionally, statistically speaking, every subsequent rate increase of just a quarter point eliminates roughly 1.4 million potential buyers from eligibility. Home sales activity plummeted from 6.12 million units in 2021 to just over 4 million in 2024, representing the weakest three-year operational stretch the sector has observed since the mid-1990s. The volume of sales is lower today than in 1995, in a country whose population has grown by 100 million in the intervening decades. However, the most counterintuitive element is that property valuations did not recede. The median price reached approximately $407,500 in 2024, a plateau from which it has largely refused to retreat. Demand collapsed simultaneously with supply, creating a situation previously unprecedented in the modern real estate market, a complete freeze. Understanding the cause of this gridlock requires understanding the invisible force holding the market immobile, the lock-in effect. Currently, approximately 51% of all outstanding United States mortgages carry an interest rate below 4%. Furthermore, roughly 20% possess a rate below 3%. An individual who purchased or refinanced in 2020 or 2021 and secured a rate near 2.75% holds a financial asset that cannot be replicated. Financial institutions will not duplicate these terms, and the current market offers no equivalent opportunity. Therefore, any decision to sell and relocate today involves more than just physically moving. It necessitates the voluntary surrender of the least expensive capital that homeowner will likely ever access, only to replace it with capital that costs more than twice as much. On a standardized $400,000 mortgage, this transition results in an additional $730 in monthly interest payments, amounting to $87,600 in extra interest costs over a decade, solely for the purpose of altering one's residential location. Research from the Federal Reserve calculates the average lock-in cost, the direct financial penalty of this exchange, at over $65,000. Under these parameters, a rational homeowner opts to remain. They stay in properties that no longer suit their needs, in locations that are no longer ideal, not out of choice, but because the underlying financial structure enforces inertia. Data from the Atlanta Fed suggests this dynamic reduces the probability of any given homeowner listing their property for sale by 21 to 23%. Analysts at the FHFA estimate this has resulted in the suppression of 1.7 million transactions that would have likely otherwise occurred. Available inventory remains 17% below 2019 levels. The metric measuring the supply and demand balance, months of supply, fluctuates between 3.3 and 3.8. For context, 6 months is required for a balanced market. This sector is not broken in the sense of an active collapse. It is fractured in that it has completely ceased meaningful motion. To grasp the magnitude of the strain on prospective participants, it is useful to examine the situation through a specific, yet common profile. Consider a hypothetical individual in healthcare administration within a typical mid-sized city, generating $74,000 annually, a salary above the national median. This person possesses strong credit metrics, no revolving debt, and has disciplined themselves to accumulate $31,000 in savings over 3 years through significant personal sacrifices. By all historical standards, this individual is the ideal candidate for home ownership. However, the market realities paint a different picture. The median valuation in this specific region is $385,000. Requiring a 10% down payment necessitates a loan balance of $346,500. At an interest rate of 6.5%, the principal and interest payment alone amounts to $2,190 monthly. Incorporating standard estimations for property taxes, $350, insurance, $150, and essential maintenance reserves, $320, the comprehensive monthly allocation escalates to $3,010.